Hello class, this lecture is going to be on Chapter 11, Corporate Reporting and Analysis. In our first learning objective, we're going to take a look at identifying characteristics of corporations and their organizations. Now the corporate form of the organization is going to essentially act as its own person. So it's going to be an entity created by law. It's going to exist separate from the ownership structure. And it's going to have its own rights and privileges associated with it. So this entity can go out and contract with either other entities or other persons on its own. Now it will have an ownership structure associated with it, and that ownership structure can either be privately held, so maybe a small group of individuals that each have a share of this company, or it can be publicly held, something that's going to have filings with the Securities and Exchange Commission, be traded on an open market exchange like the New York Stock Exchange or NASDAQ perhaps, and then be publicly held by financial institutions, mutual funds, as well as retail shareholders that can go on with their own brokerage accounts and purchase shares in this company on the secondary market. Now, there are some advantages to this type of corporation. One is that it's going to have a separate legal entity. So it's the company that goes out and enters into these transactions, not the ownership group themselves. There's going to be limited liability associated with it, where if something does go wrong with one of those transactions, the ownership structure has some kind of protection from it. So the liability in those transactions is going to be limited just to the company itself. And then there's transferability of those ownership rights. So in a privately held company, you may be able to organize a transaction to where you sell one of your shares. In our example from the previous slide, we had a small group of 5 people, each having 20% of the company. You can contract out how to sell your 20%. Now, if it's publicly traded, the transferability of ownership rights is easily done on the secondary market, where you can just call your broker and say, "Hey, I want to sell my shares of Google, or I want to sell my shares of Amazon." This corporation is also going to have a continuous life, whereas the ownership structure that forms the corporation, or is that the ownership structure that's initially associated with it, are going to pass away at some point. The corporation can survive if all those owners were to pass away, as long as there's either a plan in place for the privately held company in terms of who's going to inherit control of that, and then states will typically do that if the ownership or the owners don't do it through like a will or something like that. And then similarly for the publicly traded companies, that's going to have a continuous life to where you're just selling, you're just transferring those shares on the secondary market afterwards, to where similarly you could leave those as an inheritance to someone else, but the company is going to survive irrespective of who owns those shares based on the owners passing away. There's no mutual agency for stockholders, and there's easier capital accumulation as far as going to the market and doing such as a secondary offering. The disadvantage is going to be, the second one, talk about the second one first here, corporate taxation. So corporations are going to get something called double taxation, to where once money is earned by the venture, if it was earned by one of those owners in our privately held corporations, they would be taxed on it for their income, but that would be the be-all and end-all of it for the taxation. You've gone out, you've earned a certain amount of money, you're going to be subjected to tax, and then you pay that tax. Here, by doing it through a corporate structure, the corporation is going to be taxed on the amount that it's owed, and then once capital is returned, once the gains are returned to the owners in the form of, say, a dividend, the dividend is going to be subject to taxation as well. So there's going to be an income tax at the corporate level, and then a dividend tax at the distribution level. So there's going to be 2 taxes on that venture. The second disadvantage is going to be government regulation. So the corporations may face additional regulations that governments have put into place for those business ventures. Now the structure of it is going to be set up to where the shareholders are going to hold a residuary claim to gains of the corporation, and they're also going to own, in most circumstances, voting rights. Now you can set up on your distribution of shares, some classes of shares that might have voting rights and some that may not. But for this class, let's think about the shares having voting rights associated with them, and then the stockholders would be voting for a board of directors. So a small group of individuals that's going to run, usually from a quarterly standpoint, the company and oversee management. So they're going to oversee the CEO, the CFO, and possibly the president, vice president, and other officers are going to be put in charge of managing the day-to-day operations of that business. And then those individuals are going to be managing kind of the rank and file employees of the company. So you've got a hierarchy that's set up to where the shareholders are the ones that are going to hold the ultimate power by being able to vote out the board of directors if they don't like the direction of the company. Now, once those shares are issued, there's something typically associated with them called par value. And this was alluded to in our previous slide presentation. And I said, wait until the next slide presentation and we'll dive into it a little bit more. This is where we're going to dive into it a little bit more. Now, depending on what state you're in, some states will have a par value that needs to be associated with stocks for those companies. All the par value is going to be an amount that is required to be kept in capital. So from an accounting standpoint, we're just going to have to list that separately on our journal entries. From a business standpoint, it's something that you're going to have to pay at least that amount into the business when those shares are issued to hold that amount. And then once the company is in running day-to-day operations, they're going to have to retain at least that amount of money. And the thinking is that in case the business were to go towards insolvency and bankruptcy was on the horizon, that keeping that amount as a reserve helps preserve capital for other creditors and shareholders, and is more of a conservative, safe amount approach. In today's day and age, usually managers, if they can get around this, don't want to issue with par value associated with it because they don't want to have to keep that amount in reserve. And usually shareholders want to keep the constraints off of management, so they don't want to either. So in some states that permit it, you've also got no par value stocks, so there's not going to be any amount that has to be kept in that reserve. And then there's also something called stated value that is essentially going to be serve the same purpose as par value, but based on the language of statutes. They may just say you need a stated value to be kept in reserve. So instead of calling it par value, they call it stated value. But by and large, for our purposes, those will be almost synonymous. Now, this par value is not going to be the market value. Typically, what you would do is if you sold shares that had a par value of $1 per share, and you were to sell them at the market price of $10 per share, then we would have $10 that would be debited to the business in the form of cash. And then our credit amount for equity would have $1 of common stock or $1 of common stock par value, and $9 of something we're going to call additional paid-in capital. And we'll take a look at that, but the two values together are going to be what we would conventionally think of as the amount raised from the common stock issuance. So for the corporation's equity, it's going to consist of those two amounts. So it's going to be the paid-in contributed capital, and then it's also going to be retained earnings. So as the business goes through and earns money, any money it does not distribute out as dividends is going to accumulate on the balance sheet in terms of the cumulative net income. So let's take a look at recording the issuance of corporate stock. So for par value, if we have issued 30,000 shares at $10, and that's the only amount, and that's the amount we sell it for, of $10 par value stock, so 300,000 is what we are able to earn in this issuance. We would debit cash by 300,000. Here we're selling at par, so we've got $10 is going to be the fair market value. $10 is also going to be what's listed as a par value. So our credit is just going to be that common stock with a par value associated with it. Now, if we issue above the par value, which is typically the case, here we're going to have a fair market value of $12. We're still going to have $10 for that par value, and we're going to have 30,000 issued. So we'd issue 30,000 shares at $12 per share, so 360,000 would be debited to cash. We'd have 300,000 for the par value that's associated with our common stock. So we'd list that separately as a credit. And then we would also list the 60,000 for common stock paid in capital in excess of par value. So both issuances are related to the common stock that we issued, but we're just keeping those two amounts separate on the credit column here for the amount that is associated with the par value and the amount that is in excess or above the par value. Now if we have no par value stock, we're going to list fair market value of $40 per share. We sold 1,000 shares, so we're going to have 40,000 as debited to cash. And then we're going to have common stock with no par value associated with it for 40,000 as our credit. Now, if we issue stock instead of cash, if we take a non-cash asset as part of our formation of our company, for example, here we have 4,000 shares of $20 par value that are being issued. And then they're being issued not for cash, but for land instead. So we're going to debit land by 105,000, which is what was brought onto our balance sheet and what we earned. We issued 4,000 shares with $20 par value, so 80,000 is going to be common stock with par value associated with it. And then our additional paid-in capital is going to be that difference. So we had 105,000 that we brought into the firm as a debit. 80,000 is going to be the par value associated with the common stock. So the difference of 25,000 is going to be associated with common stock as paid-in capital in excess of that par value. So in this example, if we issue for non-cash assets, specifically here what we're doing is labor. So this is going to be kind of sweat equity financing to where we may not be given cash or we may not be giving land or property, but we're giving our time. So what we're going to do is we're going to issue 600 shares of $15 par value stock, and then we're going to ask for $12,000 worth of organization expenses, so of labor. So we're going to debit our expense of $12,000, and then we're going to credit the common stock first at the par value amount. 600 shares times $15 will give 9,000. And then that difference is going to represent the paid-in capital in excess of par associated with that common stock. So 12,000 is going to be our debit, 9,000 is the common stock with par value. The difference of 3,000 is going to be the common stock with paid-in capital in excess of par. So next we're going to take a look at transactions for dividend, stock dividend, or stock split. So first we're going to take a look at a cash dividend. These are typically going to be quarterly dividends depending on the company. To pay a cash dividend, they first have to have a sufficient balance in retained earnings, and they have to have the cash necessary to pay the dividend itself. If you don't have physical cash, you can't actually disperse it. And if you don't have sufficient retained earnings, then you're not going to be able to distribute those earnings to those investors. Cash dividends are first going to be declared, and it's going to be the board that's going to declare those dividends, often on a quarterly basis. But sometimes they may declare all 4 quarters during one annual meeting. You're going to declare the amount of the dividend itself, as well as a record date and a payment date. The record date is just going to be when you determine who's going to be physically paid the amount, and the payment date is when that payment is going to be distributed. So once the dividend is declared, we're going to, on our balance sheet, move money from the equity side, from the retained earnings, to a liability. So it's going to be considered dividend payable, similar to what we saw with an accounts payable if we might owe money to a supplier. A dividend payable is just going to be money that we now presently owe to our shareholders. And then once the dividend payment date occurs, we're going to credit cash off for the amount of the dividend, and we'll debit that dividend payable back off to where it's no longer going to be listed as liability. So for the 3 important dates that we're going to look at, the first would be that date of declaration. So we're going to record the liability for the dividend. Again, we're going to debit our retained earnings, debit equity, credit the liability as a dividend payable. Date of record, no entry is going to be required here. We're just identifying physically who the payment is going to be made to. Date of payment, we're going to record payment of cash to the stockholders, and we're going to do that by crediting the amount of the dividend payment in cash, and we're going to debit the dividend payable for that amount back off. So if we don't have, if we still want to make a dividend available to our shareholders, but we don't want to pay in a cash amount, another thing we could do is provide them a stock certificate. So we may say that, hey, we've got 1,000 shares that are outstanding. We're going to issue 100 shares of stock. So for every 10 shares you own, we're going to pay you 1 share of stock that will arrive. So this can be done to keep market price on the stock affordable. So if we previously had 1,000, now we've got 1,100 stocks outstanding. To keep the same overall market value, we're going to split that over 1,100 instead of 1,000, so that the price per share might decrease. And then also, it may be something to where management is confident the company is doing well and still wants to give something to their shareholders and feels that giving them a certificate would meet that. We're going to have 2 different types of stock dividends that we'll take a look at. One is going to be a small stock dividend, where less than 25% of the previously outstanding. So again, if we had 1,000 shares outstanding, we provide 100. If we distribute 100 shares, then that's going to be 10%. So that's going to be a small stock dividend. A large stock dividend is going to be greater than 25%. So if we had 1,000 shares outstanding, and then we said we were going to distribute 500 shares. So for every 2 shares you own, you're going to get 1 share of stock. That's going to be considered a large stock dividend. So for the small stock dividend, here the example is going to have 10,000 shares with $1 par value outstanding. And then we're going to declare that 10% stock dividend, so a small stock dividend. And then the fair market value, is what it's trading at, is going to be $15 per share. So the stock is going to be distributed on January 20th. So what we're going to do here is we're going to capitalize retained earnings for the market value, or the fair market value of those shares. So we're going to have 10,000 shares outstanding times 10% for our stock dividends. So we're going to have 1,000 shares that are going to be capitalized from retained earnings. Times $15 is going to be 15,000. Of that, we're going to have 1,000 times $10 for our par value. Take a look at how that's going to work. So we're going to have 15,000 overall, 1,000 times $15, 1,000 shares times $15 per share for the retained earnings debit. Common stock is going to be the dividend distributable, and that's going to be 10,000. So our 1,000 shares times $10 for the par value. And then we're going to have paid-in capital in excess of par value for the common stock of 5,000. That being the difference between 15,000 that was debited to retained earnings and 10,000 that's going to be the common stock distributable based on that par is going to be 5,000 for the amount. Now for a large stock dividend, let's take a look at that. Here we have our company with 10,000 shares, $1 par value stock. We're going to declare a 30% stock dividend, so this is greater than 25%, so we're in a large stock dividend. And the stock is going to be distributed to shareholders on January 20th. Let's take a look at what that's going to look like. Here we're going to capitalize retained earnings for a minimum amount required by state law, and usually that's going to be the par value or stated value, depending on what the statute says. For our purposes, we're kind of treating those as synonymous, so let's assume it says par. So 30% is going to be times the 10,000 shares. We're going to have 3,000 shares distributed. Here we're going to have $10 par, so 30,000 is what we're going to capitalize our retained earnings for. So we'd have a 30,000 debit to retained earnings, a 30,000 credit to that stock distributed at the par value. Now, the stock distributions, stock dividends, are going to be one way of providing a certificate to shareholders, and it's looks like kind of the same system as the cash dividends, only instead of providing cash, you're providing a stock certificate. Another way, if you just wanted to get more shares outstanding, would be to do what's called a stock split. So for every shares you have outstanding, today may be worth so many shares in the future. So if you do a 2-for-1 stock split, and for every share you have now, you're going to have 2 shares available to you after the stock split. So looking at the way that's going to work, if we had $20 par value for the common stock and 100,000 shares, we do a 2-for-1 stock split. That's now going to have 200,000 shares outstanding and $10 par value. So if you look at the numbers here and see that the par value is splitting as well, so the amount we have associated with the common stock par value is going to be $2 million before the stock split and $2 million after the stock split. So we're not adjusting that using a stock split. What we are doing is just changing essentially the number of shares that we're going to have outstanding. So let's look at all 4 things side by side and see which of those line items are going to be adjusted. First, taking a look at the cash dividend. If we pay cash dividend out, we're going to decrease total assets. Specifically, cash is the asset that's going to be decreasing. We're going to have no change to liabilities, and we're going to have a decrease in total stockholders' equity, and that's because we're paying the cash out of retained earnings, out of equity. And that's going to be listed breaking out stockholders' equity. We're having no change to common stock, no change to the paid-in capital. Paying that cash out of retained earnings and equity, we're going to see retained earnings decrease. Now taking a look at our small stock dividend, here we're going to have no change in the total assets or liabilities. We have no net change in total stockholders' equity. But what we are doing is we're moving some of those retained earnings or decreasing our retained earnings, and that we are providing those in the way of the stock certificate. So we're increasing the amount that we're going to have listed as common stock on our balance sheet with par value associated with it. And then we're also increasing the amount we have paid in capital in excess of par value. So the increase in common stock for par value and increase in the paid in capital in excess of par is going to be similar to where if we issued stock and earned cash. But instead of earned cash from outside stakeholders, we are doing it through our retained earnings. So we're decreasing our retained earnings and then providing that excess to our shareholders in the form of common stock, as well as the paid-in capital in excess of par. Now looking at the large stock dividend here, the same thing for total liabilities and total assets. We're going to have no change. Net stockholders' equity is not going to change. Similar to the small stock dividend, we're going to decrease retained earnings and do something with it. Here we're going to, so we're debit retained earnings. Here we're going to credit common stock, but because we're not looking at the fair market value, we're just looking at the par value, we're only going to see an increase in common stock par value. So we're not going to have any change to the paid-in capital in excess of par because we're only listing that increase to common stock par value. And then for the stock split, we're going to have no change whatsoever in anything. Literally, we're not making any kind of distribution here. All we're saying is the common shares that are currently listed, what we're doing is we are increasing by a certain amount the number associated with them. So if we previously had 1,000 shares and we did a 2-for-1 stock split, now we're going to have 2,000 shares outstanding. That's not going to change total assets, total liability, or net total equity at all. We're also not changing the total amounts of common stock paid in capital in excess or retained earnings. So we're not making any kind of distribution here. We're just changing the number of shares outstanding. And then because we are listing at common stock par value, we're going to have the per share amounts are going to change. So previously, if we had $10 par value per share, we did a 2-for-1 stock split. We now have $5 per share of the new shares after the split. So the per share prices might change, the per share par value might change, the number of shares outstanding might change, but the aggregate amounts for the company are not going to change here. So for this learning objective, we're going to explain the characteristics and distributions of dividends between common and preferred stock. So the common stock dividend that we saw, we're going to distribute cash, and that's going to be the kind of lower level of amounts that are going to be for the distribution. And those common shares, again, we can have some classes between them, but generally the common stock are also going to be the ones that have the voting rights. Preferred stock is something that we can authorize. It's going to be a separate class of stock. Typically, whereas the common stock is going to hold the residuary claim and hold the voting rights. You can have the preferred shares have priority or kind of step first in line for dividend distributions, and then distributions of assets in the case of liquidation. So if something happens where you go insolvent and you're going through bankruptcy protections, this may be something to where a bankruptcy judge may look at creditors that are in line, and when distributing the amount of what is left to shareholders, the distributions may go to preferred shareholders ahead of common stockholders. For dividend distributions, if dividends need to be paid to preferred shareholders as well as common shareholders, those dividends would be paid to preferred shareholders first. So you kind of have priority over the common shareholders in that as well. They've usually got a stated rate associated with them. And again, they normally do not have voting rights. Usually the voting rights are reserved for either a class of common stock or for common stock generally. So when you issue the preferred shares, you're going to have the amount of common stock here listed at 50,000 shares. We've got 300 shares, 30,000 shares that were issued and outstanding. So 50,000 shares is what we asked the Securities and Exchange Commission, hey, can we issue up to this amount? They said, sure. We've only issued 30,000 that was issued, and we've got 30,000 still outstanding. So this is going to be for our common stock. It had a par value of $10 associated with it. So we've got 300,000 that's listed as common stock with par value. We may have also been authorized 1,000 shares for preferred shares, but we only issued 50 shares and had those outstanding, and those have a $100 par value associated with them. So we've got 5,000 for preferred stock with par value. And then we've got paid-in capital in excess of preferred for par value with preferred stock for 1,000. We've got retained earnings of 65,000. So we've got 371,000. That's going to be the total paid-in capital that we have. Here for preferred stock, we've got cumulative versus non-cumulative. If dividend is in arrears, which means we haven't paid it, then it must be paid before dividends paid on any common stock. So if we haven't paid our preferred shareholders and we didn't pay common stockholders, so we don't have a dividend associated with them, we cannot make a dividend payment to common stockholders until we catch up or pay all the dividends that should have been paid to preferred shareholders and make them current. For undeclared dividends from current and prior years, they do not have to be paid in future years, so we can always suspend the dividend. But if we do get our preferred shareholders, if we do get those dividends in arrears, we cannot pay the common stockholders ahead because, again, those preferred shareholders are going to have priority and have stepped in front of them in line for the dividend. So looking at this preference, consider the following stockholder equity section of the balance sheet. The board of directors is going to declare $5,000 of dividends in 2018. In 2019, the board of directors declared and paid cash dividends of $42,000. So looking through our amount, 2018, we're going to have for cumulative 5,000 preferred, 4,000 is going to be in arrears here, and we've got current year preferred dividends of 9,000. So we've got a total of 13,000 for 2019 that's going to need to be paid, and then a remainder to the common shareholders for 29,000. That added together is going to get to our 42,000. So we would have for years 2018 and 2019, 18,000. That being the 13,000 plus 5,000, and then the 29,000 for shareholders. So we're going to pay the 5,000 that we've declared previously, and then we're going to catch up the remainder of that 9,000 that we should have paid in 2018 first. Pay the 9,000 to the preferred first. So we're going to pay the 13,000 is going to take priority. And then the balance of that 42,000 to 29,000 would get paid to those preferred shareholders. So if preferred stock is non-cumulative, then we're going to have the 5,000 we paid in the previous year. We paid none to common stockholders. In the current year, we paid 9,000 to those preferred shareholders. We pay the balance of the 42,000 or 33,000 to the common stockholders. So the 42,000 is going to get paid out in either situation. Here, the difference between the cumulative and non-cumulative is going to be that 4,000 that the preferred shares are in arrears under cumulative needs to be caught up first. And it's not uncommon to see those preferred shares be listed as cumulative shares to where they get that priority and step in front of those common shareholders. So the 2019 cumulative is a fairly common way to see those structured. So looking at participating versus non-participating, participating being that dividends may exceed a stated amount once common stockholders receive a dividend equal to the preferred stated rate, and non-participating being that dividends are limited to a maximum amount each year, and the maximum amount is usually the stated dividend rate. So the reason for issuing those preferred shares are going to be to raise money without sacrificing control. So this is going to be similar to the same reasons that we may be thinking about issuing debt, but instead of wanting to issue debt, we may still want some of those characteristics of issuing equity. So preferred shares, to some extent, act as a hybrid between the two, or kind of a middle ground. So it's going to boost return to common stockholders the same way that using debt does through financial leverage. So we're able to get those debt-like aspects, and it's going to appeal to investors who believe that common stock is too risky, or that the expected return on common stock is too low. So for the same reasons that some shareholders may prefer to own the debt of the company rather than the shares, those similar investors may also take a look at preferred shares and say that the stability of those shares is something that's going to be attractive to them. So it may be an opportunity to raise equity from a type of shareholder we wouldn't ordinarily be able to raise equity from. So we're also going to have treasury stock that we can purchase and sell. And what this is going to be is once we have authorized our shares to issue, we've issued shares and have a certain amount outstanding, we as the company can go into the market and do a stock buyback. We can purchase what's called treasury stock once we purchase it and list that on our balance sheet, not as something that we own. So it's not going to be it's going to be something that we've essentially pulled that amount back into our company. So what we're typically doing this for is if we want to use our shares to buy other companies. So if we're going to have a merger and acquisition to where instead of a cash deal, it's going to be a stock deal. We might buy those shares back to have them on reserve to contribute towards that merger or that acquisition. We might also want, if another company is starting to take an interest in our companies to avoid a hostile takeover, we may reserve some of that treasury stock. The main reason companies do this, though, is going to be something called an ESOP, so an employee stock ownership plan, to where we're going to purchase some of our own treasury stock, and we'll set up a 401k plan for employees to where up to a certain amount, in most companies 3% or 5%, if the company employee is going to keep that amount from their income and contribute it to the 401k, that we will match. We have the ability to match with cash if we want to do that, but a lot of companies, what they'll do is they'll match with their own stock. So we'll go into the market, we'll purchase stock of our own, and then hold that on our balance sheet as treasury stock, and then we'll use that treasury stock to pay as compensation to our employees through this 401k matching. So if they say had $10,000 of income, they had 5% is what we would match up to. So they kept 5% in their 401k. So they have $500 that they put into the 401k into a mutual fund. Then we would also provide them $500 worth of our stock into that same account. And then the fourth reason listed here is to maintain a strong market. And this has to do with providing cash back to our shareholders. One way to do it is through those cash dividends. Another way to do it is through stock buybacks, where we may say that, hey, we've got a certain amount that we're going to go into the market and purchase shares. And that knowing that we're going to come in as a buyer, people may be more confident in that share price is the thinking as we go through and make purchases if the stock maybe through time falls below a certain level, or as time goes on through certain months, that we're going to come into the market and we're going to purchase, we're going to be a purchaser of our own stock, regardless of whether other participants are purchasing it. And that is going to conclude Chapter 11.